I'm here today to talk to you about a subject which is very dear to my heart, value investing. I am a value investor, as most of you know. I have been doing this for a long time, over 21 years now. And I've been asked to come here and speak to you about this subject in a matter of about 1 hour to 2 hours that I'm going to spend with you. So I think you will appreciate that it's impossible for me to tell you what I've learned in 21 years in 2 hours or so. Nevertheless, I'll give it a shot. I'll try to make it interactive. So please feel free to interrupt me if you don't understand anything, if you have any questions to ask. Value investing is a very well-known term. But there's something terribly wrong with that term. And actually, Warren Buffett, the most famous value investor in the world, said so many years ago when he wrote that the term is basically redundant. The term value investing is redundant. What is investing if it is not the act of seeking value at least sufficient to justify the amount paid? Consciously paying more for a stock than its calculated value in the hope that it can soon be sold at a still higher price should be labeled speculation, which is neither illegal, immoral in our view, nor in our view financially fattening. Basically, he's saying that all investing is value investing. Nobody in the stock market who buys anything says that he's not buying value. He might be speculating, but I think everybody who buys anything, they believe that what they are buying is worth a lot more than the price that they are paying. So everybody thinks that they are value investors, and we all know that many of them are not value investors. So we need to understand what this whole thing means. And I rely on my teachers, and Buffett is one of my teachers, and his teacher is also my teacher. And says, I am your teacher, so you have 3 teachers. This is Ben Graham, and he said, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. Now, what does he mean by that? When he wrote that back in 1934, that definition has not changed. But what did he mean by that? So let me stay on this slide for a few minutes and tell you what I think he meant by that. Notice that he uses the word investment operation. He doesn't say this is investing and this is speculating. He talks about an investment operation. An operation means that you're doing something, it's an act. You're buying something and you're selling something, and you're buying today and you're selling it later. So it's an act over a period of time. So it's not, you cannot say that Infosys is an investment. Infosys in March 2000 was not an investment. It was a speculation. I think you know why, because there was a huge bubble in IT stocks and Infosys was selling at a valuation which gave a zero return to people who bought that stock and held it for the next 10 years. So over a 10-year history, India's most admired company, run by India's most admired entrepreneur, a debt-free balance sheet with a super return on capital, phenomenal growth. Every year after 2000, the earnings of Infosys were higher than the previous year. So the earnings grew, the balance sheet was pristine, the business model is fantastic, you got the best entrepreneur in the country, and if you bought the stock and you held it for a long time of 10 years, you made nothing. Now what does that mean? That means that the operation of buying Infosys in 2000 and selling it in 2010 was a disappointing operation. It was a speculative operation because the entry price was too high. So he's very clear about this, that he says, you cannot associate the idea of investing to a certain company. Infosys is an investment at a price. At another price, it is a speculation. A good company is not necessarily a good investment. It's a good place to look for one, but you cannot automatically assume that all good businesses will make good investments. Second, he uses the word promises. Promises safety of principal and a satisfactory return. So he's not talking about guarantee. There are no guarantees in this business. Investing, in a sense, he is telling you, is a probabilistic activity. So you have to think about odds. There are winners and losers. No commitment is made when there is an expectancy of a loss. So implicitly or explicitly, you are always thinking in terms of expected value tables. That if I lay out cash today, I might have a loss. The probability of a loss is so much. If I lose, then I will lose so much. And if I win, I will gain so much. And in the end, if you add up all the numbers, there is an expected return which is handsome, and therefore I will make that investment. Now, a lottery ticket, the operation of buying a lottery ticket doesn't produce an expectancy of a profit. We know that, of course, that the probability of winning is minuscule, even though the payoff is very large. But if you multiply the payoff with a small probability, and then when you add the probability of not winning and what you lose if you don't win, which is the ticket price, then the expected value is a negative number. So no matter what number you pick up randomly, what number you like, how you draw, how you select the number, at the end of the day, the idea of buying a lottery ticket is a speculative idea, it's not an investment. Now that doesn't mean that ideas where there is a small chance of winning are necessarily speculative. In lotteries, there is a very small chance of winning, but we call it speculation. Because even if you win, the expected value comes out negative when you compare that with the probability of not winning. But there are certain situations in investing where the payoffs of winning are small, are extremely high, even though the probability of winning is very small. I mean, venture cap is a prime example. So in that kind of a model, there will be a few winners, but the winners will be very, very large. And there will be a lot of losers, and you will lose 100% of your money in a number of situations. So you may have 10 bets, and in 6 of them you lose all your money, and in 2 of them you barely break even, and in the rest of them you make so much money that it offsets the losses that you had in the ones which didn't work out. I would still call that an investment operation. So it is important to recognize that when we talk about promising the safety of the principal, we are not talking about the safety of the principal in that particular operation. We are talking about the safety of the principal of the overall portfolio. It's important because Warren Buffett has made a lot of money by making bets where if he goes wrong, we lose 100% of his money. So he will write insurance, for example. He will write $1 billion insurance, where other people will not dare to write. He has written insurances on super catastrophe risk and on other esoteric bets that he has made, where he receives a very small premium, maybe 6 or 7 or 8% of the sum assured. But if you write a business, let's say you got 10% premium, which is very high by the standards of car insurance industry, I think you know that. But if there was a bet which resulted in a loss of $1 billion, he wrote an insurance policy that if that event happens, I will write a $1 billion check. Right? And for that, you have to give me $10 million. So he'll collect $10 million for a $1 billion payout. Why would he do that? Because the probability of payout is small. The probability of payout is so small that when you do the math, there is a very high expected value over there. He will write that insurance. Even though if that event materializes, he will have a huge loss on that bet, but it doesn't matter to him because he's sitting on a $200 billion balance sheet. So even if he loses $1 billion on a single bet, it doesn't hurt him because he's got a $200 billion over there. So he's willing to take chances where you are losing huge amounts of money on a single event and make small amounts of money most of the time because somebody is overpaying for it. That's value investing. So you have to keep that in mind that there is a difference between the idea of risk aversion and loss aversion. People are petrified of taking losses, and they shouldn't be, because there are many situations where you should be willing to take 100% losses if you can have 10,000% gains. The idea of making a 10,000% gain as opposed to having a 100% loss, if you had 20 such bets, would be a good bet to make. It would be a good system to have. That's investing. But if you put all your money in a single bet that gave you a payoff of 10,000% if you won, But 100% loss that if you lost would be speculation. So you can clearly make the, it's very bad. How many of you are engineers? Wow, most of you are engineers. Not that I have anything against the non-engineers. I myself am a non-engineer by the way. But I say that I ask this for a reason. Because the next 2 hours I'm going to ask you, because most engineers are a little more mathematically inclined than the others. I'm going to present you a few very simple notions. Very simple mathematical notions. I'm going to tell you that value investing is basically common sense. It requires some elementary application of basic fundamental mathematical principles, which I will present to you. One of them was I've already done. That you have a probability theory in your mind. You have the mental model. You know that there are situations in the world where there are events that will produce losses and have probabilities associated with that. And there are events which will produce gains and there are probabilities associated with that. And if you do all the math correct, you will end up with an expected value table. And if you have a high expected value, you should make that bet. But you shouldn't make it if the consequences of loss are devastating to you. So even a bet that makes you a lot of money, if the consequences of losing that bet are severe on your balance sheet, overall portfolio, you should enter into that bet. I mean, if it's the toss of a coin, if I told you, for example, let's say your net worth is 10 lakh rupees, and I offered you a bet, and I told you, would you be willing to bet 10 lakhs on a toss of a coin, where if you win, I'll pay you 30 lakhs, but if you lose, you will lose 10 lakhs. In expected value terms, that's a bet you should take. Yes. But you shouldn't take this particular bet because your net worth is going to get wiped out. Therefore, you should take this as a series of small bets, but you shouldn't do this one big bet. Position sizing matters. So it's very elementary mathematical principle on risk management that I think you already know somewhere, but I'm just bringing it to your attention now. There will be a few more. He talks about safety of principle and a satisfactory return. Notice the order in which he says that. He put the safety of the principle in the beginning and the satisfactory return in the end. That's important because this fellow knows what he's talking about. He lived through 1934. He lived through the Great Depression of 1929 to 1934. He lost almost all his money. He realized how hard it is for you to come back if you lost almost all your money. So he knew what matters is the safety of the principle should come first and the satisfactory return should come later. I know it sounds common sense, but common sense is not that common. In financial markets, often people invert this relationship, particularly when things are going well. Imagine when you're in a raging bull market, when everybody is making money, something like that is happening right now, as we all know. Then people start thinking about a return on their money instead of return of their money. How much money they can make this month, how much money they can make this week. They don't, and therefore they start thinking about, they don't think so much about risk, they think about returns. But when things are not going well, when the market will turn and there will be losses, there will be speculative companies which come to market and they will offer their shares in IPO bubbles to people who buy those shares. And when those decline 80 or 90%, then people will realize what a mistake they made. Then people will start to know the return of their money and not the return on their money. I think it's terribly important to recognize that if you are investing, you're always thinking about the return of your money before you think about the return on your money. You want safety. Again, you want safety at the portfolio level. Again, the point I'm making is you will lose almost all your money in a single commitment, and yet you might be investing because your overall portfolio risk is low. Second thing, the last thing about this slide that I want to tell you is that nowhere in the definition of the contrast that Graham talks about between the idea of investing and the idea of speculation, he talks about long-term versus short-term. There is no mention of that. There is a tendency to believe that if you are thinking long-term, you are an investor. I mean, think about this for a moment. If you bought a stock at $100 and it dropped to $10 and you made a huge mistake and you recognize you made a mistake and you refuse to sell it and you're holding on the last 10 years, are you an investor just because you hold it for 10 years? You're still a speculator. You speculated, you made a mistake, you lost, and you're making a second mistake by not recognizing your first mistake and fixing it. So you could have long-term speculators and you could have short-term investors. Nowhere in his definition he's talked about the holding period. That's one important point to understand, that there is a tendency to believe that all people who are buying and holding for long-term are always, investors, and people who flip it in a day are traders. Generally speaking, that's true, but not always. Indeed, some investment operations are necessarily short-term. Risk arbitrage is one class of value investing where you are a short-term investor. You are buying something today with an expectancy of selling in the next few weeks, months, or sometimes even days, sometimes even overnight. But that doesn't mean that you are speculating merely because your holding period is a day. He doesn't talk about stocks versus bonds. So there is this tendency that if you are a gambler, if you are a speculator, if you are one of those people, then you must be buying stocks. And if you are buying only bonds, you're putting only money in a fixed deposit, then you are a conservative person and therefore you are playing safe and therefore you are investing. Again, nothing could be further from the truth. Think about this for a moment. Buffett talked about it many years ago. If you buy a treasury bond today and hold it for the next 10 or 12 years, I think almost certainly you will have loss of purchasing power, because inflation is more than the rate of interest. And that applies, I think, in many countries around the world over a long period of time. So what are you trying to do when you invest? You're trying to end up with more money than you started with, and more money that will help you buy more stuff. Because you're delaying gratification today to have more money later on, to consume more things later, right? That's what investing is about. But if you lay out cash today and you conservatively put it in a bond, and after 10 years you may end up more money than you originally laid out, but that more money does not buy you more stuff, then you have had a permanent loss of capital. Inflation creates permanent losses of capital, and people don't understand that. People think that they are being conservative by buying fixed deposits and FDs and fixed income securities without recognizing that if you do that, you are almost certain to lose money in the long term. If you buy well-selected equities, on the other hand, at least you have some hope of making a lot of money. What would you rather do? I think the question doesn't need to be answered. We all know that. Again, he doesn't talk about income versus profit. There is no difference between capital gains and income. You may be investing in an income asset. You may be, speculating in a capital gain situation. There is no difference. A rupee of capital gain on a post-tax basis is no different from a rupee of dividend on a post-tax basis. They both buy the same thing. So you don't try to think that, I'm going to make a lot of money on this on dividends. Therefore, I'm being conservative, and I'm going to make no dividends on this one, and that is only going to be a long-term capital gain thing, therefore it must be necessarily speculative. It doesn't work that way. Lastly, he doesn't talk about leverage on your own money. Notice, he doesn't say that, if you are investing, you must invest your own money. And if you are speculating, you must necessarily use leverage. You could be an investor with cheap leverage. Indeed, some investment operations require the use of leverage, otherwise you won't make any money. Because the spreads are so low, the return on asset is low, but unless you spike your return on equity with the help of cheap debt, you don't make any money. And the situation is amiable to debt financing. There are some class of value investing which I will not go into called special situations, where you can't make money unless you use leverage. But you're still adhering to the underlying principle. Your principle is safe, you have a satisfactory return, it won't come to you unless you use leverage. I think that will still be investing. On the other hand, you will be investing your own money in a .com company without taking any leverage, because no bank will anyway give you leverage against a .com company back in the year 2000, and you're still speculating. So you could speculate with your own money, but you could be investing by using leverage. So again, notice that he really drills down to what really matters. Let's move forward. There are three key principles of investing that I want to share with you, and they were articulated by Warren Buffett. He learned it from when Graham, of course, and he quotes him on a number of occasions. Principle number one, investors should look at stocks as a part of ownership of a business. And you know, it seems common sense, but I see it all the time, people don't do that. They know the price per share, but they have no idea what the market cap. They don't know whether this is a 100 crore company or a 1000 crore company. They have no idea. But they know the stock price is 50 bucks per share or 70 bucks per share. They know the PE multiple, they know the EPS, but they don't know the aggregate market value of the company. They don't think in terms of aggregate businesses. They think in terms of stock being a piece of paper, a stock certificate, or an entry in your demat account. Underneath every stock and bond is a business, and you have to learn to think like businessmen and women. What does that mean? That means that even though you don't have the money, you have to imagine that you had a lot of money, and you were offered this whole company at this aggregate market value, which is the stock price multiplied the number of shares outstanding, the market cap. And you have to ask yourself the question, would I own this business at this price? And if the answer is overwhelmingly no, then you shouldn't buy 100 shares. You shouldn't buy 1000 shares. You shouldn't buy 10 shares. You shouldn't buy any shares in that business. And that's fundamental. It is not always followed. In fact, it is mostly not followed. It's a very simple idea. And people just don't do the basic math of figuring out how much is the total company selling for. So I'll give you an example. So Buffett gave that in 2000, I think in his 2001 AGM, he talked about this example. He talked about a hypothetical company. It had an aggregate market cap in that dot-com era of bubble era of about, I think, $400 billion. And he said that imagine that you had all the money in the world and you could buy this, you were offered this business of 400 billion. People are crazily buying the shares of this business, but they're not doing the mental mathematics of multiplying the number of shares outstanding with the amount of with the stock price to come up with the aggregate market value of the company. But let's do the math. Let's play a thought experiment. And trust me, this kind of thought experiment helped me a lot in keeping away from a lot of nonsense in the market. I'll give you an example of that as well. So Buffett said, imagine that I bought this business for $400 billion. This is the market at which price at which I'm being offered this business today. If I'm willing to buy 100 shares, I should be willing to buy a whole business, all of it. So I'm paying 400 billion. And let's say my expected return is 10%. I'm not very greedy. I want to earn a 10% return per annum. Which means if I bought this business today, I should earn $40 billion post-tax. On a pre-tax basis, it's probably about $60 billion, right? And then he says, well, there are many businesses which don't earn anything right now, or they don't earn the amount that I need right now, but they earn much more later on to compensate for the time value of money, right? So it's perfectly logical to lay out cash in a capital investment project. It doesn't give you anything right now, but it must give you more in future years to compensate for the period during which you are not sufficiently paid. So he factors that in his calculation. And he says, assume that this is a startup, assume it's got great potential. If I'm paying $400 billion to buy this, it must give me $40 billion of post-tax profit and $60 billion of thereabout of pre-tax. And I'm not getting anything right now. It doesn't earn anything right now. That's fine. It should earn maybe $66 billion next year. And if it doesn't earn anything like that next year, so he keeps on going back and going forward in time and tries to figure out what the business must earn 5 or 6 years down the road for him to make it worthwhile for him to own that stock today. And then he shows that it is mathematically impossible for that business to be earning that kind of money, because no company in the world at that point of time was ever making any kind of that kind of money, number one. Number two, to make that kind of money, you would need to have revenues which would require you to have a market share of more than 100%. And that's not going to happen. That's called proof by contradiction. You all learned that in school. It's an elementary trick. You start by assuming that some absurdity is true, something that you want to disprove is true, and then you show that if it was true, it will lead to some absurdity. A trick that you learned in school is being applied to Warren Buffett in valuation of business. And I found the same situation in 2007 in Suzalon, a stock which was selling at an aggregate market cap 46,000 crore rupees. If I need a 10 or 15% return, how much earnings it must provide to me on a post-tax basis and a pre-tax basis, and I roughly know what kind of margins it has. So I keep on moving up on the P&L. I keep on trying to figure out what kind of revenues the business must have 5 or 10 years down the road to produce the kind of earnings 10 years down the road, to produce the kind of necessary earnings that will be available 10 years down the road for it to justify the valuation today. So I'm moving up. As I move up, I come up with the revenue number. That revenue number consists of two things: business volume and prices that you are charging for per megawatt of installation. You only know what prices you are roughly charging, so you need to get an idea of business volume, right? So you get a rough idea as to how much wind power capacity this company would need to be able to deliver to its customers, roughly speaking, and you don't have to be precise, you have to be roughly right in this, 10 years down the road to justify the valuation today. And when you did that math, you find that there isn't enough space on the planet to have the sites, and you're an engineer and you're smiling at me, to have the sites which will have the wind power available near the population. I mean, there is enough wind in North Pole, but people don't live on North Pole. You may be living in the most, you may have a very windy part of the planet, but people don't live there. You have to have windy areas near where people live, and the best sites are taken first. So I'm talking about incremental revenues. I think you get the point here. Do not give up your engineering background. Do not give that up. These are very elementary principles, and Charlie Munger once said that you have to reduce a problem to a discipline which is more fundamental to your own discipline. Investing is social science, but you can apply very elementary mathematical principles and principles of physics and principles of engineering to effectively prove that something absurd is happening out there, and I don't want to be part of it. So the loan dropped. In fact, it went up by another 50 or 70% before it dropped by more than 95% subsequently. At the end of the day, all stocks and bonds are represented by a business, and you have to think like a businessman. That was the first principle. Second, what was the second? Oh, I repeated the slide. Investors should look at market fluctuations in terms of Mr. Graham's Mr. Market example and make them your friend rather than your enemy by essentially profiting from folly than participating in it. Now, in his book, The Intelligent Investor, Ben Graham came up with a metaphor of a fellow called Mr. Market. Let me explain what that is. Mr. Market is a person who is your partner in a privately held business. He's nuts. He is what Buffett subsequently called as semi-psychotic. He is either extremely delighted or he is extremely despondent and suicidal. There are days on which he is extremely elated, he is very happy, he thinks only good things lie ahead. On those days he comes to you and he offers to buy your stake from you at a ridiculously high price in that privately held business. There is no stock market quote out there. And there are days on which he thinks the world is going to come to an end and there is no future, and he is suicidal, despondent completely, and he comes to you, take my stake at a price which is way below what the underlying value is based on reasonable, common sense principles of valuation. And then there are days on which he is neither this or that. How should we behave as a reasonable person in this situation? Well, Graham wrote that you can afford to ignore him most of the time. But on some days when he is extremely crazy on either direction, you can take advantage of him. And that's exactly the same idea that applies to buying publicly listed securities. The stock market quotations are available to you. Earlier they used to be available with a lag of 15 minutes when they have those paper tickers. Today you have it in real time. But the mere availability of stock prices doesn't mean anything. In fact, it is detrimental, because if you start thinking, well, Mr. Market is omnipotent, he knows everything. He's an authority out there. Mr. Market is not an authority. Mr. Market can be wrong. This goes at the heart of the efficient market hypothesis. Most academics believe the markets are efficient and there are no mispriced opportunities. People like Warren Buffett, people like Ben Graham and his students, people like me, believe that That is wrong. Markets are often wrong. And when they are wrong, you should take advantage of them. You should sell your shares in business. You have a mental framework of a mindset of a private investor. And you are thinking whether it is overvalued or undervalued. If it is grossly overvalued, then you will let go of it. If it is grossly undervalued, you will buy more of it. And that's the mental frame. You will not let Mr. Market influence you. The availability of stock prices don't mean anything. If only they give you a certain advantage. Because the other people around you, you compete against, they think differently. They are influenced by stock markets. They are hooked on to CNBC. So you don't need CNBC, you don't need television, you don't need daily stock prices. In fact, stock market can shut down for the next 5 or 10 years and it shouldn't bother you. That's the mindset that you should have when you think about stock prices. And the third one, which I will stick with for the rest of this class, is the one which matters a lot. It's about the idea of margin of safety. The three most important words in investing are the margin of safety, which means always building a 15,000 pound bridge if you're going to drive 10,000 pounds truck across it. And it is, I mean, you're engineers and you understand this very well. When you build a bridge, you insist it can carry 15,000 pounds, but you only drive 10,000 pound trucks across it. And the same principle works in investing. He's talking about the idea of margin of safety. The idea is coming directly from your discipline. It is coming from engineering. We call it redundancy. And I'll quote Wikipedia on the subject. I think you'll be much more familiar with what I say now than I am, but I think I got the gist of it. Redundancy in engineering. Duplication of critical components of a system with the intention of increasing reliability of the system, usually in the case of a backup or fail-safe. In many safety-critical systems such as fly-by-wire aircraft, some parts of the control system may be triplicated. An error in one compartment may then be outvoted by the other two. In a triply redundant system, the system has three subcomponents, all three of which must fail before the system fails. So you understand probability. You know that the probability of each one of failing, and there are independent probabilities. So all of them must happen before the plane crashes. Since one rarely fails and the subcomponents are expected to fail independently, the probability of all three failing is calculated to be extremely small. Elementary probability, right? The same logic applies in investing. Margin of safety. How does it apply? In many ways. So we have to talk about what are those various sources of margin of safety. One of the most common ones which are known to people who want to practice value investing is the idea of margin of safety from a low price. You're paying a low price. You're buying a bargain. It's worth 100, you're paying 40. So even if it turns out to be not worth 100 but 80 or 70, there is still a margin. You can go wrong on the value, but the margin is so huge, then it's okay. And Graham came up with a lot of simple rules to guide you about this kind of margin of safety. And they are very easy to understand. If you know a little bit of accounting, you obviously understand engineering, it's not very difficult. For example, again think of private business. You walk into a restaurant and you want to make an offer to the owner of the restaurant that I want to buy your restaurant. It's a nice, profitable restaurant. You find it has no debt. It's a successful restaurant in a nice location. It comes with real estate. It comes with a brand. It comes with a clientele who are loyal. It comes with pricing power. But you make an offer which makes the owner feel that you actually belong to another room in the city. And that room is the IIM Ranchi. And the offer that you make to him is that the money that I will offer to buy your restaurant is less than the money that is in the till. One day's sales. I want to buy a whole restaurant with the entire stock in trade, the goodwill, the real estate, the brand value, the loyalty, everything for less than the money in, and there is no debt for this. you would think that this fellow really belongs in that other room. But Mr. Market is that person of the other room. He does want to offer you such businesses occasionally at below cash. And that's what Graham called as cash bargains. Now there are businesses which are profitable, they're not losing money, so the cash is not going to be dissipated away. These are profitable businesses, low profile businesses, might be fairly illiquid stocks, but the market is in such a depressed frame of mind that the whole business is being valued for less than cash. And there is no debt. So even if you want to buy this whole business today and sell it off, you will get more than what you paid for. You will get way more than what you paid for. Now you might think this is such a ridiculous proposition, but he came up with a very simple notion that occasionally in the stock market you find such situations, and if you find such situations, then on a diversified basis you should buy into these situations. It's a very simple idea. It's a no-brainer. I mean, it's very hard to argue with such an idea, except that if you think a little more deeply. Because you are using the notion of buying into a publicly held security, which is selling below cash. Now you have to think the opposite. So what happens? How can I lose money in buying it? It is too good to be true. If I buy it, before I buy it, what can cause me to lose money? So let me give you a few illustrations where you might actually lose money when you do this. One, the guy who runs the company is a crook. You are buying a publicly listed security. You are buying half of 1% of the company and you own 65% of the company. He doesn't pay you a dividend. He has his daughter who is unqualified to do anything else to be on the payroll of the company and drawing a lot of salary. He has his son who is a complete nincompoop to be the vice president of the company. They are all drawing fabulous salaries, and you can do nothing about it. It's perfectly legal, by the way. And therefore, you are a minority investor in a company, in a business which is run by a crooked person who has no interest in sharing the benefits of that business with you. Is it really irrational for a stock market to price that business at below fair value? I would argue that the market is not really irrational. But I would also argue that market sometimes becomes extraordinarily irrational and prices are well below where it should be priced, even after considering the negative points that I mentioned. And that's where Grant said you should get it. The other example would be, although it didn't apply to the restaurant, is that if you're buying into a business which is losing money, it's bleeding cash, and there is cash, and you're buying because you're seeing the cash and you're seeing the bargain and you're being seduced by it, but you might lose money because the cash is being dissipated away because of losses. So there could be 3 or 4 reasons why walking into these situations could be like value trap. There is value, but there's also a trap out there. So you have to be a little more careful, but the idea is that occasionally businesses do tend to sell at well below what they are worth. And when they do that, even if they are run by people who are not the most admirable people, buying them on a diversified basis and holding on to them for periods of time about 5 to 6, between 3 and 5 years, has in the past been a reasonably successful investment operation. And I think the best way to understand the idea of value investing using the concept of margin of safety as applied by Ben Graham is to actually go to a casino. So let's go to a casino.
I'm not only legitimate, but I'm running a casino, and that's like selling people dreams for cash. I hired an old casino pal, Billy Sugar, as my manager, and I went to work. Guys like me, but Vegas washes away these sins. It's like a morality car wash. It does for us what Lourdes does for humpbacks and cripples. Legit comes cash. Tons of it. I mean, what do you think we're doing out there in the middle of the desert? It's all this chance. And that cash goes from the tables to our boxes, through the cage, and into the most sacred room in the casino. The place where they add up all the money, the holy of holies, the count room.
This is a scene from a movie called The Casino. If you haven't seen it, I would recommend that you do. So why are we talking about value investing and casino in the same sentence? Well, let's look at it from the perspective of the theory of probability, which you're so familiar with. You all done this mathematics when you were in school. So here is a popular game in casinos called the roulette, and here is the not the wheel, but where you put your bets, place your bets. In American roulette, there are 38 slots in the wheel, numbered 1 to 36, 0 and 00. And the payout ratio, if you win, is 35 to 1. So let's do the math. If you bet $1 on your lucky number 8, and if the ball lands on number 8, you win 35 bucks, otherwise you lose $1. Right? Let's say you bet instead on 7, it doesn't matter. You wager $1,000 on a single number, say 7. Then the probability of ball landing on 7 is 1 on 38, that is 2.63%. The probability of your losing is 97.37%. And if you do the math, the NPV of that $1,000 bet comes to $52.63 negative. So it's a losing bet, right? It's a negative NPV. You shouldn't do this, right? But what's this got to do with value investing? A lot. Let me explain. Let's say you try to say, I want to spread the risk. I'm conservative. This is gambling. I don't like gambling. I want to invest, and I want to spread the risk. Let's say you spread the risk by putting 1,000 rupees on every number on the table. 0, 00, 1, all the way to 38. So you put your number 38, 36. I apologize. 36. 38 numbers. So what will happen if you practice diversification? If you practice diversification, you end up with the same result. You will surely end up with 1 win. You will end up with 37 losses. And if you add on the number, you find a very important principle that diversification does not work when the margin of safety is absent. There is no margin of safety. The margin of safety comes from the positive expected value, your negative expected value. Now what this got to do with value investing? Let's invert the situation. Who is really the investor here? Let's think of the problem from the perspective of the casino operator, not us, not the gamblers in the room. Think about what is he doing. He is offering you a bet that if you were to diversify, put your money across the table, 1,000 rupees on each, if I was the casino operator, I was sure to win. I was sure to win $52.63. No matter what happens, I'm going to win. Right? In the earlier situation, there was a small chance that I might lose a big amount of money. But in the second situation, there is no way I can lose money. Right? So let's look at the problem from the perspective of the value investor in the room, the owner of the casino. Every bet has an expectancy of a profit, because if it's a loss-making bet from the point of view of the gambler, it's a profitable bet from the point of view of the operator. Even though some will eventually result in a loss. Second, you practice by diversification. Casinos want to have by diversity. They encourage active play. They love people who have these systems. That I will spread my money, I'll put in 3s and 4s, and I'll put in odds and evens, I'll put in blacks and reds, and so on and so forth. No matter what you do, you're going to lose. That's the absolute the mathematics of a casino, right? And the third thing that they do is they put a cap on max bet, position sizing. That no matter what, even if you end up in a situation like this one, even if somebody puts money on a 7 and the ball lands on 7, I'm going to lose 35,000 bucks. I don't want to lose 35,000 bucks. Or I don't mind losing 35,000 bucks because my net worth is 3.5 crore rupees, it's very small. but I want to put a cap. I will not enter into a bet where the total payout is 3 crores or 4 crores or some such number that will ruin me. So there is no chance of a ruin. You find that there is no casino out there who will allow you to have an unlimited bet out there. Because if that event happens, you don't want black swan event. You don't want to have a situation where you go all the way to zero. And that's effectively the principles of investing. You want to have an expectancy of a profit on every bet that you make. You want to practice diversification so that even if things don't work out well in some, they will work out well in the other ones. And our overall portfolio, you're okay. And you don't want to end up with a black swan, negative black swan. And this particular chart, and the table below, I think little important. You really can't tell when somebody is investing or gambling until time has gone by. Because what appears to you to be as investing might actually be gambling. You can't decide based on how your performance looks like in the short term. But if you keep gambling in the long run, you go below the line. You will end up with losses. Luck will, kind of even out. But if you keep investing sensibly over long term, there will be divergence. That was the first part of the table, of the message of this slide. The second message of the slide is in the table below, the process outcome matrix. That you have outcomes and you have the processes that will create those outcomes, and you could have a good process that delivers a good outcome. We call that a deserved success. But you could also have a good process that produces a bad outcome. That's just really bad luck, bad break. That should not deter you. You may have acted smartly, but you may have ended up with the results that makes you look foolish. You should be willing to look foolish so long as you have not acted foolishly. It's very important. A lot of people don't do that. I gave the example of Buffett happily entering into an insurance contract where he may lose $1 billion, and if he lost $1 billion, he will look foolish. But he's not acted foolishly because he had an expectancy of a profit on that situation. He has taken care of the size of the bet being very small in relation to his overall portfolio, and he does many such bets, not just one. So he may eventually have one bad bet, but for a normal person who is a professional, who is employed, who is the CEO of an insurance company, entering into such a bet would be very difficult from his career perspective. Because if the bet doesn't pay off, you could get fired. How do you explain it to your board of directors? How do you explain to your stockholders that you made huge loss in a quarter because you made one bet and the bet didn't go right? The point that I'm trying to make is that the world focuses on outcomes, not on the underlying process. And that gives people who focus on processes and not outcomes a competitive advantage. Insurance companies, typical insurance companies don't want to enter into that space, and that's why Buffett can ask for a $10 million insurance premium, which is way more than expected value of that bet. Because there are no competitors out there. Because they don't want to enter the space. Because the people who are contemplating entering the space are running away because they are loss averse. Buffett is risk averse but not loss averse. The two things are very different. He doesn't mind taking risks. So he doesn't mind taking losses so long as he has not acted in a risky manner. And when I say risky, it doesn't mean that you will not lose money. You will lose a lot of money on a single situation, but you will not lose money on the overall. Even if you have a huge loss on a single situation, it will not impair your ability to live and thrive. That's investing. And Buffett has created a competitive advantage for himself in that space. There are very few people in Super Cat and in these esoteric bets that he makes. He's exactly exploiting other people's loss aversion. You may have a bad process and a good outcome. People will think you're a hero. And there are a lot of people out there who may be just, dumb luck. They are experiencing dumb luck, but it's only a matter of time when the luck will run out. Simple statistics tells us that. Simple theory of probability tells us that. And of course, if you keep on doing dumb things, time after time you'll end up with poetic justice. So I think it's important to recognize that people who focus on processes, not outcomes, and try to fix their processes if they are not right to get them to work properly, are way better than people who don't focus on processes. Now let me give you the example of 4 businesses which will provide you with some insights on how to think about business economics and how to think about valuation. You can see the numbers.
Yes,
So these are four hypotheses. I'll go through fairly quickly in this. It's very easy to understand. There are very few but very terribly important messages that I want to illustrate with this example. There are four businesses and they're all debt free. The prevailing rate of interest in the economy is 10%. And these four businesses have different characteristics. A earns a return on net worth of about 6%, which is very mediocre because it's way below 8%. B is also a mediocre business. C and D are superior businesses. They earn much more than the going rate of interest in the economy. Let's say 1/4 of this class runs company A and 1/4 runs company B, and likewise for C and D. And you get paid 20% of management fee earnings to you as management fee. And I put that to illustrate the idea of perverse incentives in these businesses, in some of these businesses. And you guys decide the payout ratio. So the management of A decides to pay out nothing, the management of B decides to pay out everything, the management of C decides to pay out nothing, the management of D decides to pay out everything. I do this to illustrate the idea of pairs. So we create pairs, we compare A with B and A with C and so on and so forth, and we find that their outcomes are different, but we try to isolate as to what is causing the difference in the outcome, what causal factors are causing the difference. So let's do that. Let's start with A. We start with $100 of opening capital. Because you have a total earnings of 6%, you make 6% in year 1. You get paid $1.2 as management fee. Your net earnings is $4.8. You don't pay any dividends because that's your standard dividend payout policy. Your ending net worth is 104.8, right? And you have 10 shares outstanding, and your EPS is 0.48. If I just extrapolate the same assumptions for the next 10 years, this is how the numbers will change. The closing net worth of year 1 will be the opening net worth of year 2, and will keep on increasing. The book value will keep on increasing simply because you are earning money and you are not paying it out as dividend, even though the money that you are earning is very mediocre in relation to the going rate of interest in the economy. So that was example 1 of a poor business run by a management team which is hell-bent on retaining capital and putting that capital back into the business, and therefore resulting in increased net earnings for himself, management fee for themselves. So as you can see, the management fee is growing not because the management is smart, it's growing because you are simply retaining capital in a poor business. Simple, elementary compound interest, right? Come back to elementary mathematics. That was business A. Now business B is also got terrible economics. It earns 6% return on capital, but the management somehow decides that the rate of interest in the market is 10%. This is a lousy business. We are fiduciaries. Our job is to maximize the wealth of our owners. Let's give the money back to them. And let's see what happens. So they have a dividend payout ratio of 100%. As you can see, whatever they earn every year, $4.8 is paid out. So what I had received, supposing I am the stockholder, I get $4.8 in year 1. I can put it in a fixed deposit which will mature after 9 years. So I want to see what happens at the end of 10 years. So what I receive from the company at the end of year 1, I can put it in a fixed deposit for 9 years. What that I keep on receiving and reinvesting in fixed deposits, they will all mature at the end of 10 years to 76 rupees and 50 paise. I will also have a book value of $100. That won't change because I am paying out everything. So on paper I show that I am worth $176 and I was worth 159.81 in the earlier situation. I have already shown that I am better off being an owner of B than being an owner of A, right? And the only reason why that is happening is because B is run by a owner-oriented manager. Right? Now let's come to C. C is a fantastic business. It earns 20% return on capital. It has opportunity to reinvest that money back in the business. It's a scalable business model. You can take in more capital. You can grow more capacity. It's in the business where there is huge, untapped potential. And you keep on putting money back in the business. It keeps on delivering 20% return on capital. And if you do this, at the end of 10 years, you will end up with a net worth of 441.14, which is way better than the earlier two situations. I'll have zero dividends, however. The book value will be rising. Notice the book value is rising in A and in C. But do you really want the book value on A to rise? Before you answer that question, think about what happened to B when the book value did not rise. Being an owner of B was better off than being an owner of A. But in A, the book value is growing, and in B, the book value is not growing. In A, the earnings are also growing simply because of compound interest. It's simple elementary mathematics, right? It's like a bank account. If I lock my money in a 2% bank account, every year for the next 20 years, every year's interest on that bank account will be more than the previous year's interest. But is that growth really good growth? I could have instead not put that money in a fixed deposit and put that money in a 20% fixed deposit of a business. That would have grown much faster and much better. But I'm locked into this situation. So being an owner of B is way better than being an owner of A, and being an owner of C is way better than being an owner of A or B. So I'm using elementary idea of compounding. What about D? D is a non-scalable but high quality business. It doesn't have opportunity to reinvest the money back in the business, so they pay it out as dividend. It earns high returns on capital but pays out everything. And as you can see, the terminal value of dividends that have been reinvested become 255, and you end up with a net worth of 355. Now I ask you a few questions. Assuming the same assumptions also apply in the future, the great businesses will remain great, the management quality will remain the same, the payout ratios will remain the same, the interest rates will not change. Under those circumstances, if I wanted to approach another knowledgeable potential buyer of this business, let's talk about him, and I want to sell it to him, he also knows the same assumptions apply, and I told him the book value is 159.81, paid 159.81, would it be logical for me to ask 159.81 for this business? How many of you would say yes, that would be logical? Nobody raised their hands. How many of you would say it would be illogical for me to expect that? Why?
The net worth is rising each year, as you can see.
I didn't get it.
And the net worth is increasing year on year.
What is increasing?
The net worth of the company.
Yes.
That's increasing year on year. So the next year the value of the company will be more than the current value.
Okay. So you think I should be paid more than 159? Why would somebody pay me more than 159 for this business when this business will continue to earn 6% on that?
Because there's no scalability in the business. So nobody would pay this.
It deserves to sell at below book value. This is a poor quality business, therefore it deserves to sell at below book value. The same logic applies to B. C deserves to sell at a premium to book value because it's a fantastic business, it's a compounding machine, it is growing its business at a rapid pace and the internal rate of return is very high. All of the things that you look for in a great business. Similarly, D would also sell at a high price to earning and price to book value ratio. So I think one thing is very clear, that the principle that you derive from all of this, the elementary principle of business economics and valuation that you derive from this is this. Assets are worth more than book value when they are expected to earn a return on capital employed which is more than the market rates of return, and vice versa. If I own an asset which can earn 20% return on capital, in a world when the rate of interest is 10%, I can command a premium valuation. But if I owned a business which earned only 6% return on capital, then clearly I don't deserve a good valuation, I deserve a discounted valuation. Second, assets lost in the hands of a manager who thinks and acts in the interest of owners are worth more than identical assets lost in the hands of self-interested managers. We saw that when we compared A and B. B was run by good management, A was run by what we would define as poor and self-interested management. And we showed mathematically that you are better off owning B than owning A. Third, all growth is not good. There is good growth and there is bad growth. Good growth creates value, bad growth destroys it. We saw that when we talked about A and C. A was growing, C was growing. But A was growing and the internal rate of growth, the incremental return on capital was still 6%. C was growing and the incremental return on capital is 20%. And we know the growth of A was not good because you can compare it with the non-growth B and show that you are better off owning B than A. So in a sense, the growth of A is destroying value, whereas the growth of C is creating value. Fourth, quality matters. Leaving the question of price aside, the best business to own is one which over an extended period can employ large amounts of incremental capital at very high rate of return. Think C. The worst business to own is one that must or will do the opposite, that will consistently employ the ever greater amounts of capital at very low rates of return. Think A. Buffett has elsewhere said that the worst business of all is one that grows a lot, where you are forced to grow just to stay in the game at all, and where you are reinvesting the capital at very low rate of return. He cites the example of the airline industry, for instance. The airline industry has grown tremendously over the years, but most companies in that business, in that industry, don't make any money. There are strong reasons for that, and I will not go into the details, but I think roughly you already know it's a competitive industry, high capital intensity, a perishable commodity type nature of the product, negligible pricing power. A lot of things can go wrong in the industry. A lot of things must go right for the plane to take off. If one kind of staff goes on strike, the plane doesn't take off. And if people keep on offering all kinds of freebies, then you have to match it. There's all this intense competition in an industry of that quality results in very poor returns on capital over time. It's also the industry with the highest mortality rate. Most bankruptcies happen in that industry. So there are many reasons which go into the idea that growth in some industries is not going to create value. So don't get impressed by growth. But we saw C. We saw something fundamental happening in C. And what I want to tell you is that you're engineers and you know mathematics. You may not know a lot of accounting, but I just gave you very little flavor of it. But in the end, I'm going to tell you a lot of stories. In the end, it will just boil down to this. In the end, it will just boil down to the point that Mr. Buffett is making. That time is a friend of the wonderful business and the enemy of the mediocre. You saw how $100 became $441 in 10 years in the case of C. Right? And if you extrapolate it further, you saw there will be a breakout. What am I trying to tell you? I'm trying to tell you an equation. A very simple equation. That if you combine compound interest with longevity, and if you combine it with a reasonable price, you got a secret sauce of making money in public securities. I'll come back to the equation again and explain that. But all the stories about brands and brand ambassadors and low cost advantage and all of those things, in the end, all of those stories that you will hear and you've heard and you create in your mind when you think about investment thesis, in the end they converge to this simple equation. That there is a business which has high return on capital, which is compound interest, part of the equation. Secondly, there are reasons to believe that this business will continue to compound capital at a high rate of return, which is to do with entry barriers, which is to do with competitive advantage, which is all the stuff that you read in your other papers like Porter and other competitive strategies. And then there's the third element, that if you became partner in such a business at a reasonable valuation and exercise a lot of patience, then you just have to sit back and let the business compound capital internally for you for a long time to produce wealth. Isn't that obvious? You know how compound interest works. I've already shown you that, and you already knew that. I've not told you anything that you don't already know. Reasonable valuation, compound interest, and longevity produces wealth. So quality really matters. Charlie Munger once said that if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you will end up with one hell of a result. And I don't have to go into the Excel sheet again. I think you can visualize it. If I knew that C would deliver 20% return on capital for 10 years and even beyond, and if I paid a 20 PE multiple of that for that stock in the beginning, or a 25 PE multiple for the stock in the building, and held on to it for the next 20 years, I think you can demonstratively, easily show that you will still make a lot of money. But if I bought into a business like A at 15 PE multiple, you will come up with the conclusion that the results were quite disappointing compared to paying up for quality in the case of C. So the idea is very intuitive and it's correct that you should pay up for quality, which is what Charlie Munger is saying. And you should pay up for quality because of compound interest and longevity. So do not assume that a business for 5 P multiple is cheaper than a business for a 15 P multiple. The 15 P multiple business might actually be much more attractive than a 5 P multiple business because of compound interest and longevity. The 15 P multiple business has got an internal rate of return on capital employed which is very, very high and is likely to remain high, and they can reinvest capital and grow it over time. Therefore, the terminal earnings of that business are extremely high, and even if you apply a moderate multiple to those earnings, the money to be made by buying it at a reasonable multiple today and selling it over a period of time will be very, very high for you. I will give you some examples. And the fifth principle is that you have to have discipline. Price changes everything. You can't apply the earlier principles indiscriminately. You can't pay a 400 P multiple for a wonderful company like Infosys in 2000 and expect to make a lot of money. So there are limits. You can overpay for things, and that's why the definition that the quote that Buffett said, leaving the question of price aside. What are the best business to own? What are the worst business to own? But you can never leave the question of price aside. It's always a factor in the investment decision, right? So the elementary idea that there is a price that is too high for a great business, and there is a price which is so low that even a mediocre business becomes more attractive, those are very good ideas. But I think what is important is to understand this equation. Everything in the end boils down to this for long-term investing in equities. Compound interest plus longevity plus reasonable price is like producing wealth creation. Now the key questions are, what produces the compound interest plus longevity? And what produces the reasonable price? So I have two explanations for that, and I will now offer them to you. Notice what is the meaning of compound interest? A high return on capital, the ability to compound your owner's capital at a high rate of return. And then longevity means that you can do it for a long time, which means that you are doing something unique, which is in a capitalistic society hard to replicate. Logically, if I could make a lot of money in a business and the entry barriers were low, then I should not make a lot of money in that business after a period of time, right? If the markets are well functioning, if I am operating in a capitalistic society, then it's only a matter of time when high returns on capital will mean reward. That's a logical thing to expect, right? But what makes returns not mean reward? This is what Warren Buffett calls a moat. It's a very powerful metaphor. It's a metaphor which goes like this. That there is a castle, which is the moat around it, which is the water body. And the castle is that high return on capital business. And the moat is what protects it from a competitive attack. And management is working cautiously to make the moat deeper and wider, and management is throwing crocodiles and piranhas in it and anybody who enters that mode is going to get killed. So people will not even enter, and the mode keeps on getting bigger and deeper. So the metaphor is that of a competitive advantage of an entry barrier. If you have that, then you have a sustainable, then you get longevity, right? So there are a lot of businesses which have castles but which have no moats. And there are businesses which have castles which have narrow moats or not so wide moats. And there are businesses which have castles which are like castles with deep and wide moats with bananas and sharks thrown in them. And if you can find those businesses, and if you could pay a reasonable valuation for that, which is the third part of the equation, if you could do all of those three things, then all that you have to do is to sit back and let the power of compound interest and longevity create the value pyramid. It's very elementary. Let's see what creates that. So, capitalism is a lot like, the honeybee situation. Now there is this honey out there, and it's very sweet, and there are going to be a lot of people who want to have that. High return attracts competition, so unless there is a sustainable competitive advantage, returns on capital will be rewarding. Without the sustainable competitive advantage, businesses with high returns should see those returns dwindle as competition moves in. And companies with low returns see them improve as either they move into profitable lines of business or their competitors leave the playing field. But some companies are able to withstand the relentless onslaught of competition. What creates the moat? That's the question. Let's just think about it, and there are overlapping. There's no time to talk to you about in detail because I have lectures just explaining one of these concepts. But I think you'll get the gist of what I'm trying to illustrate here. So this is not necessarily an exhaustive list. These are models which I've used to help me understand. 4 of them come from a wonderful book called The Little Book That Creates Wealth by Pat Dorsey. I would recommend you to read that book. It's a fabulous book. I think you should all read that book. And then there are other things that I've learned, picked up over the years, and this list will keep on increasing. And there's not an overlap. So I'll explain to you what I mean by the overlap. I think it's very important to think about moats from the perspective of customers as well as competitors. So I'll come back, I'll keep on going to and fro between various slides. So one of them is intangible assets, which means brands. Could be patents, could be copyrights. What is the meaning of that? I mean, you have got something which nobody else can use. If I have a chewing gum which is called the Wrigley's chewing gum, then I own that. If I own that brand, then I've got dominance. What does that brand do? How did the brand get created? Why do people pay more for a Wrigley's chewing gum than for an unmarked or a relatively unknown chewing gum? Why? Because of marketing, because of advertising, because of distribution, because of a number of things. But the cost of doing that might be enormous for a new entrant to discard you. And if you walk into a foreign country, if you fly into a foreign country, if you want to, buy a chewing gum, then you're relatively price sensitive. You don't want to put something unfamiliar in your mouth just to save a little amount of money, right? I mean, this is a quote from Chalmanga. Your mouth is a very personal kind of place. You don't want to put some unfamiliar object in your mouth just because you're saving a little bit of money. So you pay a little money, and that money, when you spread over billions of sticks of chewing gum that are sold every year, translates into hundreds of millions of dollars of extra earnings for Wrigley's. So that brand creates everything. In the end, it's sugar and rubber, right? If you think it from point of view of chemist, you will wonder why the hell are people paying for such a high price for something called Wrigley's? And the other thing is equally good. It's chemically indistinguishable. But chemically indistinguishable things are not indistinguishable in the mind of customers. And when you are able to manipulate the mind of the customer to believe that this brand is what will make you a better person or a happier person, and therefore you should own it and not the other thing, and you should pay a little extra for it, people believe in that and they generally feel happier because they use that. All of that produces enormous amounts of wealth. and it's very hard to dislodge. Customer switching costs. Customer switching costs are many kinds of customer switching costs. One of them is financial. It's just too expensive to switch. And some of them are psychological. There's a mental inertia. I don't want to make a switch. But I'll give you an example. So, you run a bank. How many of you are IT engineers? A lot of you are IT engineers. So you would be familiar with the idea of a banking software, a core banking software, right? So let's say Oracle is the supplier of a core banking software platform, and your bank works on that. There are bank customers who work on that platform. Now, what is going to be the customer switching cost for the bank, for the customer? How expensive would it be for the bank to switch a vendor? If somebody else came up with a better mousetrap than Oracle, would you switch? Why would you switch? Why would you not switch? And you have these notions that people are unlikely to switch. Well, the best way to test that notion is to look at customer retention rate. How many of them renew their licenses? And you find that it's almost 100% in this industry. The only reason why you don't you switch is because you are merged into somebody else, and the other fellow said, "My IT system is better than yours." Shut up. The point is that there are some industries where customer switching costs are extremely high. That you've been able to get an entry into your customer's doorstep, and you have become they become your captive client. They are clients for almost for life. So customer switching costs are very high. Now think over here from the perspective of the fellow who has to decide once in a while that should they stay with Oracle or should they shift to Polaris, which is the competing software, Indian company. And interestingly, both companies in India came out from the same original Citigroup company. I don't remember the exact name. But Oracle went one way, OFSS, and Polaris went the other way. But what you find is very fascinating, that if you are the person who has to make the decision that should I stay with Oracle or should I go with Polaris, and Polaris people have come and made presentations, and they have demonstrated to you that their product is better than that of Oracle. And they provide to you that financially it's much cheaper, so financially it makes sense. Even then you will not make the switch. Why will you not make the switch? It's your call. Because if the call goes wrong, you are screwed. It's your career risk. So switching costs are often psychological. So you have to understand that there are often reasons why you end up with industries or businesses with extremely high switching costs, and those people who are creating that won't understand that, and they keep on increasing those costs. They keep on giving you freebies and add-ons and upgrades, and makes it very hard for you to make that switches. They make you go down a certain kind of a technology. To switch technology platforms is not easy, as I think most of you know better than me. You have the idea of network effects. If you're all familiar, I'll use Ola cabs over here. It's a fabulous experience. Download the app, press the button, they come. But the value of Ola, which is the network, basically it connects drivers with users, right? Or Uber, or for any of that matter, or for that matter eBay, or for that matter a stock exchange, or for that matter a mall. All of these things, what do? They connect people, or Shadi.com, or all kinds of new business models that are coming up, Airbnb. All of these things are essentially intermediaries who are connecting people, but the value of the intermediary goes up, the network goes up, as number of users increases. You know the network economics. You are engineers, you know the power of networks, and how the value of a network increases as the number of users increases, grows exponentially. But what happens is that, and the original network effects in economics came in the newspaper industry, I think. So you are the dominant newspaper in a small town. So, or even a big town, you had Hindustan Times in Delhi, and you had Hindu in Chennai, and you had Statesman in Calcutta, and you had Times of India in Bombay. And you found that if you are a business, if you are a retail store in Mumbai, you want to advertise in Times of India. You don't want to advertise in the Hindu, which is also published in Mumbai. Why? Because most people end up subscribing to the Times of India. So you have a high subscription rate which creates high advertising. And high advertising creates high subscription rate because people want to see where the sales are. People want to see where the discounts are, where the new restaurants out there. So circulation drives advertising, drives circulation, drives advertising. It's kind of a virtuous circle, keeps on going on for a long time. And you have network economics in newspapers until newspapers got obsoleted by the internet. The point I'm trying to make is there are some businesses which by the nature of the very business model and because of luck, because of first mover advantage, because of whatever, they end up becoming the Facebook. They end up becoming the eBays. They end up becoming the Ubers and they end up becoming the Airbnbs and therefore they become worth a lot of money. A low cost advantage is easy to understand. If you can sell something which is cheaper than the others, you have an advantage the other guy cannot replicate it because of many reasons. It could be access to a low cost raw material. It could be a geographical advantage. It could be a phenomenal corporate culture which also relates to the idea of low cost advantage. An extremely frugal management which operates at such vapor thin margins and still are able to deliver high returns on capital. The other people are not able to do it. And I know a business model which do that. And I'm invested in a company which makes money, more than 40% return on equity, in a very tough business, which has international operations and the CEO and the entire senior management team around the world travel economy class. It's very hard for a multinational company to operate on that basis. Nobody will want to work for that company. But this company has a corporate culture of extreme frugality. Walmart has an operating culture of extreme frugality. Costco has a culture of extreme frugality. So there are these business models which are run by extremely frugal people, deliver exceptional value to clients, to your customers, by keeping costs so low that make it extremely hard for somebody else to replicate what you're doing. Reputation reminds me of a business I invested in some years ago called Ashiana Housing. Now in the housing industry, in the home building industry, almost everybody is screwed up. But Ashiana didn't screw up. They didn't make 4 or 5 standard mistakes. They didn't siphon out the money of one project, take it from the customer, then put it in another project. They didn't treat land as if it was something to be banked. They treated it as a raw material. They focused on execution. They delivered on time. Almost always on time and within their cost. They built a reputation. That reputation gave them certain advantages. You see, imagine if there is a builder with a stellar reputation, what are the kind of advantages that he would enjoy? One, pricing power. If you launch a project and your competitor has launched a project, you will charge higher than the others. Those few 300-400 rupees a square foot can make a lot of difference. One. Second, you get paid earlier. The other guy has to fund it by taking loans from banks and pay interest on that. You get money from the customers on 0% rate of interest. You get flow. So a reputation of doing the right thing, of being ethical, also creates a kind of a competitive advantage, which in some industries, which are run mostly by people who have cut corners on those parameters, end up having a very significant competitive disadvantage. I think it's useful to think from the perspective of customers as well as competitors. Why would a competitor not enter this marketplace? What will make it hard for somebody to enter the marketplace? Why would a customer not switch? Why is a customer buying your product? Why is he preferring to buy your product? So let's look at the first one by letting Mr. Buffett give you an answer to that.
Yeah, you and Mr. Munger have long talked about franchise value of businesses. And without tipping your hat, I'm just curious as to what areas y'all everybody do very well with a business like that. The franchise is in their mind. I mean, it's the experience they have. It's the first time they had it, they'll she kissed them afterwards or whatever, or slapped them. I mean, that's what we like to do with the competitors, candy. But, and as you know, they're not going to go home on Valentine's Day and say, here, honey, here's 2 pounds of chocolates. I cooked them all bit. I mean, it just doesn't work. So if you've got the right kind of product that way, if you're really showing up or whatever it may be, if you're paying, you may be paying for taste in this case, you may be paying for a mental association that you have, you may be paying for service availability or a lot of things, but that's franchise value. Then the question is how franchise is basically like a moat around your economic castle. Now, there's two things there, but how big is the castle? Coca-Cola is a big castle. See's Candy is not a very big castle, but it's a castle. And around both of those, there's a moat. And that moat is either slightly eroding or slightly growing all the time. It may be based on advertising, it may be based on service, it may be based on employee training, it may be based on research. A lot of things. I mean, there are all kinds of things you're trying to do to make that moat bigger and bigger and to throw more piranha and crocodiles and et cetera into the moat. And you need a moat in business to protect you from so that in the long run we're kind of cheaper. That's what we're looking for all the time. And you can't find it all. You know, you're not going to find it in carbon steel. You know, you're not going to find it with an integrated oil company or something sort of all like that. But you won't find, you don't find very many. Very few. If you have 10 good ideas in the rest of your life, that, you know, you can afford to give away 5 of them. That we'll get very rich with a very few good ideas.
Buffett was trying to answer the question, why would somebody prefer to buy your product and not somebody else's product? And I cited here the various sources of competitive advantage. And I want to now explain to you how they kind of interlink with each other. So I'm going to give you some examples and I'm going to tell you how they link with each other. Now, why do I tell you about this? And I'm not going to go into the financial performance of these companies. I think you would know, and if you haven't, all you have to do is find out how these companies are performing 10 years ago, 5 years ago, and now. And what was the market cap 10 years ago, 5 years ago, and now. And almost all these companies will be between 50 to 100 and plus backers. All of these businesses have done three things. Two things: compound interest and longevity. So how do they do that? I think you already know part of the answer, but I want to add a little bit more to that. Let's go to the Pidilite case. What does Pidilite make? Fevicol. What is Fevicol? It's a chemical. But it's not just a chemical. It's a chemical that is used in, fixing one wood to another wood, right? And most of the countries in the world, the guys who end up buying that furniture have no role whatsoever in deciding what adhesive goes in that furniture, right? Pidilite has converted a B2B product into a consumer brand, and it's absolutely amazing. I mean, if you look at around the world, there aren't very many countries out there in the world where something like that happens. Look at Astral pipes, plumbing pipes, turned into an iconic consumer brand. How? It's advertising, it's surely its distribution, it's brand ambassadors, it's a lot of things, as you can see. But the point is very different. The point I was making earlier, that these are all stories. These are all stories which are creating the numbers, which are producing the compound interest and the longevity, which, if you can identify early on, by pay a reasonable price for them and just sit back and let them do all the hard work for you, you're going to make a lot of money. Let us go back to the point that I was making earlier. Go back to this list. Intangible assets. So you saw Pidilite, the Fevicol brand. Now, if you have the unmarked kind of an adhesive which was chemically identical, people will still buy Pidilite. Why? Because you have created the mental association. All these things, funny things, are the most iconic, advertising, history of advertising in the country, as you would agree, it comes from this company. So they have been able to create a brand which people don't mind paying up for. And we know that they don't mind paying up for, because if you didn't have the money, if you didn't spend the money to create all this brand, you could have tried and still wanted to operate at the same margin, you could have sold it at a much lower price. So if people who are buying this brand and product, effectively paying for the brand creation and are very happy to do that, and allows the company to make a lot of money. The moat comes from the brand, it comes from the distribution. It comes from the marketing bandwidth that the company has. But what else does it do? That is the first level of work that we have done. Once you have done that, once you have become the dominant player in this industry, you get scale. And we know how scale works, again very elementary economics. If you get scale in an industry, you get a cost advantage. Why? Why do you get a cost advantage? Because a lot of costs are fixed costs, and if you have a large volume of business, then the cost of the fixed cost per unit of production and sale is very small in relation to a new entrant. To illustrate that idea, think Relaxo. And I mentioned that I have a blog. I would invite you to go and study in detail about why I like Relaxo. I and a few of my colleagues, looked at that company a few years ago, and one of my friends and I gave a joint lecture on that business about 2 years ago in MDI, and the transcript of the lecture is on the website. We said in that lecture that let's look at the problem from two perspectives. Let's look at this brand. They create the brand. They sell, at the time they were selling 100 million pairs of footwear at about less than $100 a pair, less than $2 a pair. So you are earning 35% return on equity by selling 100 million pairs of footwear, flip-flops, for less than $2 a pair. Now, one thing is, from the point of view of the customer, why are people buying it? Because Salman Khan is telling them to buy it. I love Salman Khan. Salman Khan says that he buys this and he loves it, and he's telling me to buy it, so I should buy it. Very simple, holistic kind of reasoning, which creates the mental association between our love for Salman Khan and the brand loyalty. So people buy that. That is the easy part to understand. But what else does it do? It gives you scale. Once you get scale, you get certain advantages. What are the kind of advantages? Let's just think about the kind of advantages that Relaxo would enjoy because of scale. It's the largest non-leather footwear company in the country. Why have other people not entered the market? Why is this so hard? First, the price point. You are selling the damn thing for less than 100 rupees a pair. You are selling 100 million pairs, 10 crore pairs. Let's imagine, and a lot of the costs are fixed costs, like advertising, like these brand ambassadors. They've got 3 brand ambassadors, each of them get paid about 4 or 5 crore rupees. If you amortize 15 crores of payout to 3 brand ambassadors over 10 crore pairs, you are paying 1.5 rupees per pair. Now imagine that a new entrant entered into the market and he said, I want to dislodge Relaxo. I will hire the same brand ambassadors. I'll pay them 15 crore rupees. I'll buy slightly more expensive and I'll pay 20 crore. I'll buy do both the models. I'll pay get even more expensive brand ambassadors, or I'll get a cheaper one. But one thing you know for sure, that when you start the business, when you start with either the expensive brand ambassadors or the cheaper ones, you're not going to start year 1 with 100 crores of 100 million pairs of footwear. You're going to have 1 million pair, 2 million pair. Let's say you have 10 million pair. It could relax a long time to get to 10 million pair. Let's imagine in 1 year you end up with 10 million pairs, and you have the equally expensive brand ambassador. 15 crores of 1 crore is 15 bucks per pair. The profit that Relaxo makes is 4 bucks per pair. You could bleed money by getting into that business because the price point is so low. He's kept it low and he can charge a higher price. There is an equivalent company in Brazil called Havaianas, which started out like Relaxo 30 years ago, more than 30 years ago. It sold its flip-flops as beachwear to poor Brazilians and gradually built a brand. Today the brand is the world's iconic brand in beachwear, footwear, and the cheapest same plastic, rubber footwear that you find in Havaianas stores and in Amazon.com, the cheapest one sells for $18 a pair. Same raw material. There are Havaianas pairs available on their site and on Amazon.com that boyfriends will buy for their girlfriends for $150 because they have Swarovski crystals in them. There is a pink one and a blue one and a different one a girl wants, one every week. And they've been able to do that by the same logic, advertising, but you get scale. Now the point I'm trying to make is, by keeping prices low and still being able to earn a 35% margin, you achieve 2 things. You get poor people who were earlier buying unbranded products, but they see a Salman Khan movie, they feel a little bit like Salman Khan by buying that thing. They feel emotionally close to that person. They don't mind paying 100 bucks. 100 bucks is very small sum of money for even an Indian laborer to pay. So people are moving away from unbranded to branded, and this is just one example of one company that applies in many industries. It's a pattern that is playing out. So people are buying branded products. Low price branded products sold in very large quantities provide companies like Relaxo scale advantages. It gives them the ability to generate cash to afford to hire a Salman Khan, which nobody else can afford, because even if they could afford, they will have huge losses. So now you know the answer. Why are people not entering this market? And then you think about, well, how likely is it that they will enter the market over a period of time? And after all this growth, after being more than a 50 bagger, Relaxo today represents 5% of India's footwear market. So if you think about scalability, if you think about what Havaianas has achieved, there is a long runway ahead. So you're looking at longevity, you're looking at compound interest. That was the basic idea which I talked about and of course, I looked at the stock originally, it was selling at less than 12 or 13 times earnings. I think it's important to recognize the factors that create the stories, that create the numbers, that create the wealth. The factors that create the stories over here, and they will come in many combinations. You may have a brand combined with a low cost advantage. You may have a niche market where nobody wants to enter because it's too small, and somebody goes and builds a niche out there, and once you've done that, it's very hard for somebody else to enter. I think it's important to recognize that there are these basic building blocks, so to speak. I'll use that term, I think it comes to my mind. These are the building blocks. It produces the stories. The stories are accentuated and reinforced by people like you, done MBAs in marketing and all kinds of funky subjects, like finance, who go and manipulate the consumer into believing that you really should pay a lot of money for a glue. Your bathroom, pipes inside the wall, which you'll never see, should have Astro written on them. Because Salman Khan fought with that pipe in a movie, and that means strength. So you have these wonderful associations that Salman Khan is strong, I love Salman Khan fought with the pipe and beat that shit out of that fellow, the pipe didn't break, therefore I want that pipe. But it goes further. The guy who is influencing the installation of the pipes that are sold by Astral are the plumbers. And this company knows how to use plumbers. I don't know if you know this, but this company takes thousands of plumbers for training. This company gives free movie tickets of Salman Khan movies, obviously, to these plumbers. And this company is able to show that if you use our pipes instead of the regular, pipes out there, you will be able to do the same job in 1/3 of the time. Therefore, it pays you to pitch our product. They are the salesmen of the company. So this company understands the power of incentives. So they are psychologically astute. And I think all of that adds up to create the high return on capital, to create the scale, to create the brand, to create the pricing power, to create the compound interest, to create the longevity. And if you can, buy these businesses of 15, 17, 18, 20, even 25 times earnings. Not that I've paid anything close to that, but if you had done that of Pidilite, you would have been very happy today. I don't own Pidilite, never bought it, but I cite that as an example of something that I should have bought. It was obviously now staring at my face. The point I'm trying to make is over and over again the same one. And there are these situations which solve the problem that I posed earlier. My question was, what produces compound interest and longevity? And I gave you some examples. That was fine. But what produces a reasonable valuation? Everybody knew that Pidilite was a phenomenal product. People want it. People know about Relaxo. People know about so many other businesses which have done fabulously well. Now, one of the things that you recognize about the idea of valuation is that if you bought an overvalued asset and you held it for a long period of time, logically you wouldn't make a lot of money in it. You should actually have losses in it. I mean, the idea is very simple. If you're overpaying for something, it should hurt you, right? Now, what I wanted to, I don't have time for this, but what I wanted to show you empirically is that what appears to many people, especially those value investors who are trained to think superficially in terms of historical PE multiples, what appears to them as expensive is not expensive. And you only have to go back in a time machine to see what PE multiples at which the sum of these businesses have sold. And if you had bought them at what appeared to you as a high PE multiple and held till date, how much money you would have made. That was point number one. The second point is what creates a reasonable price. And I have a theory about that. And that theory has to do with marshmallows. And there is a famous experiment called the marshmallow experiment, which was cited many years ago. There's a book also called the marshmallow experiment, cited many years ago in a TED talk by this person.
And here I have a very important message. I think we have found the most important factor for success. And it was found close to here, Stanford. Psychology professor took kids that were 4 years old and put them in a room all by themselves. And he would tell the child, 4-year-old kid, Johnny, I want to leave you here with a marshmallow for 15 minutes. If after I go back, this marshmallow is here, you will get another one. So you will have two. To tell a 4-year-old kid to wait 15 minutes for something that they like is equivalent to tell us, we'll bring you coffee in 2 hours. Exactly correct. So, what happened when the professor left the room? As soon as the door closed, 2 or 3 ate marshmallow. 5 seconds, 10 seconds, 40 seconds, 50 seconds. Some lasted 14 and a half minutes. Got away. What's interesting is that 1 out of 3 will look at the marshmallow and go like this. We look at it, put it back. They would walk around. They would play with their skirts and pants. That child already at 4 understood the most important principle for success, which is the ability to delay gratification. Self-discipline, the most important factor for success. 15 years later, 14, 15 years later, found out study. What did they find? They went to look for these kids who were now 18 and 19, and they found that 100% of the children that had not eaten marshmallow were successful. They had good grades, they were doing wonderful, they were happy, they had their plans, they had good relationship with the teachers, students, they were really fun. A great percentage of the kids that ate marshmallow, they were in trouble. They did not make it to the university, they had bad grades, some of them dropped out, a few were still there.
Why do I show you this? This is a very interesting experiment that occurred. The idea that I picked from this is the idea of delayed gratification. And the idea of delayed gratification is obvious to anybody who has ever done any DCF. And you understand the idea of time value of money. That a penny saved is a penny earned, or a bird in the hand is worth two in the bush. That the value of money 10 years out has to be more than the value of money today. So when you do DCF, you do present value analysis. And in that present value analysis, you use discount rates. And you use it explicitly, you put a discount rate number. The kids in this experiment are also using a discount rate. Let me explain how. The discount rate was as follows. That I have a marshmallow which has already been given to me, and I have a choice. I wait 15 minutes and don't take the second marshmallow, or I take the second marshmallow right now. Now, the kids who would take the second marshmallow right now have implicitly done the following calculation. That the present value of a marshmallow 15 minutes from now is not as high as the value of it right now. Right? They've done the calculation. That's why they're preferring to have it now than to wait 15 minutes. They're not being adequately compensated. If the number was 3 or 5 or 10 marshmallows, maybe they would have agreed. But 2 marshmallows 15 minutes from, one extra marshmallow 15 minutes from now was not worth it. They wanted it now. So in a sense, they did not discount delayed gratification low enough. If the discount rate they had used in their calculation was a low discount rate, then the present value of the delayed gratification would have been higher. And therefore their choice might have been to wait. They did not wait, which means implicitly they used a high discount rate. So that is one part of the story. Now let's just come to the second part of the story. The second part of the story has to do with the capital asset pricing model. And I'm on the last couple of slides, so I'm going to finish. And Warren Buffett talks about the idea of investing in a moated business. I've already explained that to you. You love the idea of a business, or investing in a business that has an enduring competitive advantage. He loves the idea of a business that will grow over time. He absolutely loves the idea of compound interest and longevity. But how does he value such businesses? You see, these businesses are going to grow and create a lot of cash flow over long periods of time, so there is a lot of delayed gratification. Right? How do you value businesses which have a significant amount of delayed gratification? He says, the capital asset pricing model type reasoning with its different rates of risk-adjusted returns and the like, we consider it nonsense. But we think it is also nonsense to get into situations or try and evaluate situations where we don't have any conviction to speak of as to what future is going to look like. I don't think that you can compensate for that by having a higher discount rate and saying, well, it's riskier and I don't really know what's going to happen, therefore I will apply a higher discount rate. Now I'm going to tell you two things which are going to shock you, I think. One, Warren Buffett doesn't believe in capital. That's all obvious. Second, when he values a business in which he wants to invest, a moated business which has long enduring competitive advantage, he uses a 30-year treasury bond yield to make that valuation. Think about that for a moment. He does not believe in the idea of an equity risk premium. Why is he doing that? He is doing that because he is like that child who delays gratification, who doesn't mind waiting. But to be able to make it worth his while to wait, he has to use a discount rate that is low. That was one part of the story.